Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Coupang. So Coupang is an e-commerce player in Korea. Its aim is to be the fastest delivery service for Koreans. Its stock is down 40% since its IPO, and the business is approximately 89% derived from the commerce business side of the operations, and then it has 11% that are kind of, let's call it, innovative opportunities. So I'm going to kind of go through this, and I think that you'll see that paying just 2 times forward sales for this business is probably quite attractive. So as already alluded to at the start, the stock is down 40% since its IPO. It's quite interesting because it's kind of been that theme around 2021 that a lot of these kind of high growth and profitable opportunities, the market is just like doesn't really want a lot to do with it. So it's quite interesting. You take that or leave it as you want. So when I talked about Coupang last time, a few months ago, I said the big question needs to be addressed is, can Coupang continue growing at 60% compounded annual growth without incurring heavy losses? Since its results came out a few days ago, I think that's actually more pressing that question than it was back then. So here's the thing. Growth rates were up 48% year over year. Now think about this, right? Coming into 2020, there was an acceleration in the growth rate. And 2021 appears to be a mirror image of that. So there seems to be a consistent deceleration in growth rates. And management talked about this on the call and said that they believe approximately 5% of the revenue was the management decided not to actively take on new customers, or there was constraints in the supply, and it wasn't a lack of demand. It was really that all these COVID restrictions in Korea, and they just decided that to optimize, keep the customer experience quite high, that it was better for them not to take on new customers. So they felt that approximately 5% of the revenue was sacrificed towards that. So you're kind of looking at approximately, let's say, 51% year-over-year growth rates that it would have been. So it's not the end of the world. It's still a reasonably fast-growing company, irrespective of what the share price would lead you to believe. So during the earnings call, they talked about the fact that they didn't want to really compromise on the experience, that there is a lot of demand, and that there isn't a lot of reason why they might not accelerate again, what management called, quote unquote, a noisy quarter for them. So if you think about it, right, so Coupang operates in a very, very competitive market in Korea, and they believe that they have an infrastructure, an end-to-end technological advantage over a lot of its peers, that they can bring down the cost of their products so that they can deliver low prices to consumers or customers. So with that in mind, when the active customers into Q3, you can see here into Q3, slightly declined, investors are like, okay, it's clearly not really resonating with customers, because it is something that I've often alluded to. One of the best things you want to look for when you're looking at a company is you want to see a rapid acceleration in customers or consumers or users. You want to see, that's really the key driver of the revenue. You can work with pricing power later on down the stream, but what you really want to be focused on is the number of customers coming up. And here you can see that there is deceleration. They can still point and say, okay, active customers were up 20% year over year. That's true, but sequentially it has slowed down, and that's led a lot of investors to be apprehensive. One of the things I want to highlight is that if you look back to Q2, they had discussed that their mature business, which is within the commerce side of business, the mature segment, used to be EBITDA break-even or even slightly profitable. And when they were questioned on the earnings call about this into Q3, they skewed the question slightly, and they just said, okay, quarter to quarter there is always going to be some noise that obscures improvements that we're seeing in the underlying profit drivers. There's some short-term disruptions like COVID and our timing of investments. So they skewed the question, but they kind of gave the sense that, this is temporary. Take that or not is up to you, but I just think that they're probably right that this is just a bit too much compression on the revenue growth and not just been percolating all the way through the EBITDA profitability. But I believe that if things stabilize, that they could see an improvement here in their profitability profile. Now, one of the highlights, one of the kind of crown jewels of the Coupang investment is Eats. Okay, so it's the delivery service that they've got, and within its other segment or other revenues, they've got a few different categories. They got Eats, they've got advertising, and they got Wow Deliveries, which is essentially kind of like Amazon's Prime. So they don't disclose in a lot of detail around this, but what they do say is, you can see here the figures in the screen. So for Q1 21, the other segment was up 125% year over year. For Q2, the other segment was up 150% year over year. For Q3, the other segment was up 113% year over year. So they're clearing triple digits. It's not that big a deal. They're clearly growing. The other segment is growing quite fast. And I put this screen here. So 11% of Coupang's revenues come from its other segment. Now, if you fast forward, let's say 12 months, you kind of getting to the point where the other segment kind of coming up to 15% of the underlying business. So at that point, it starts kind of getting interesting. You're kind of probably getting up towards, let's say, 1.5 billion in revenues, perhaps thereabouts. So it kind of starts getting quite interesting then. So right now, investors are kind of like, I don't want anything to do with this, but I think that it actually looks better than it seems. So one more thing that I want to highlight about the operating leverage. As the business is growing, there's been a slight improvement in the gross profit margin. So it's gone from 15% to 16%. It doesn't seem that attractive. If you remember that pre-COVID, it was around 20%. So even before COVID, it was never a very fat margin business. But if you remember, e-commerce isn't a fat margin business. Look at other e-commerce players. It's you're working off really razor thin profitability. What I wanted to highlight is that if you take the adjusted EBITDA margin, it went last year's Q3 was negative 5.6, whereas this year's was negative 4.5. So when everything is said and done, they're not that burning through that much cash flow, and they got plenty of cash on the balance sheet. If I memory serves me, they do have a tiny bit of debt, but I think they got about 3.5 billion of net cash. So they can continue going at this rate for a long time because they have a very fat amount of cash on the balance sheet. And that's one of the advantages of really investing alongside founder-led businesses, because that's something that they're always thinking about. How can I continue to invest for growth? The stock is priced at 2 times next year's sales, okay? So think about this, right? Mercado Libre is priced at 8 times next year's revenues, and C Limited is priced at 14 times next year's revenues, okay? Now, C Limited is a better business, right? C Limited is growing at more than 100% year over year, and it's going to be a long time until they're kind of growing at approximately 50% compounded annual growth. On the other side of the scale, you got JD.com. JD.com is priced at approximately 0.8 times next year's revenues, and they're going to report their results tomorrow, so we can kind of find out how that works out. But for all intents and purposes, paying just 2 times forward sales for Coupang seems okay. Remember that JD.com might or might not come around 35%, 36%, something like that, revenue growth rates, something like that. Coupang is still growing meaningfully faster than that, so you're not paying a very large premium for the stock. So as we just circle back, one of the things that kind of might put people off is that the active customers are not moving in the right direction. But I believe that if you were moving in the right direction, you wouldn't be asked to pay just 2 times forward sales. So, it's a bit of give and take, but I believe that there's a reasonable amount of margin safety here. If you want to find out what kind of stocks I'm particularly bullish on and investing right now, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor, help you build a portfolio and think about that. Check out my reviews, what other people say about the 5-star reviews about my marketplace. Okay, thank you for listening.